Hello, welcome to Accounting with Mr. H, and welcome to this power-up session for AQA A-Level Accounting. My power-up sessions include a mix of questions, activities, explanations, and worked examples to help you revise the different sections of AQA A-Level Accounting. And in this power-up session, we are going to be revising sections 1, 2, and 3, which are tested or can be tested in both paper 1 and paper 2. Please do subscribe to the channel. Thank you so much if you already have. Like, share and comment on the videos. Let me know what you find useful and what you'd like to see in future videos. Just before we start this power-up session, just a few things that you will need then to be organised. You will need a pen or a pencil and some paper. You will need that to write down some answers to some questions, maybe draw a couple of ledger accounts and so on. You will also need a calculator, and if you're planning on completing this power-up session all in one go, it'll probably take around about an hour, so I would have a drink ready and make sure you have removed all those distractions, such as your phone, computer games, social media, and so on. Right then, here we go. So as I'm sure you know, the exam papers for AQA, both paper 1 and paper 2, each paper starts with 10 multiple choice questions. So in this power-up session, we're going to have a few multiple choice questions here and there, and we're going to kick off with 3 multiple choice questions. If you look at the marks and the minutes in the exams, it works out about 1.5 minutes per mark. But with the multiple choice questions, some of them need calculations and some of them don't. So my advice is, for the questions where you don't need to do any calculating, I would be trying to do those questions in about 30 seconds per question. And then the ones where you do need to do some calculations, about 1.5 minutes as a rough rule of thumb. So what I'm going to do in this, I am going to move the slides on after those times. So if there's no calculations after 30 seconds, I will give you 1.5 minutes if there are calculations involved. So are we ready then to kick off? So 3 multiple choice questions coming up, and the first one is coming up now. Last few seconds, and moving on to question 2. More seconds on this one. Last few seconds. And time is up. Okay, let's review then our answers and we'll have a quick chat about why each one is the correct answer. So question 1 was to do with section 2, which includes types of business organisation. Which of the following is not an advantage of a sole trader? And you can see there the correct answer is C, the owner has unlimited liability. Unlimited liability is actually probably the biggest disadvantage of being a sole trader. Remember, it essentially means that because there is no difference in law between the owner, the sole trader themselves, and the business, the person, the sole trader, is ultimately responsible for anything and everything to do with the business. So if the business were to incur a lot of debt, let's say there was £20,000 of debt to be paid up back, and the business didn't have that amount of money, the sole trader themselves would be liable, responsible for paying back that £20,000. And that might mean they have to sell some of their personal possessions, like their own car, maybe even their house, in order to pay that. And that's why it's called unlimited liability, because the owner is liable, responsible for any debt until it's paid off, unlimited. The others here are advantages. You don't have to publish your accounts. Limited companies do, but sole traders, they don't have to publish their accounts. The owner keeps all the profit to themselves, assuming they've made some profit. And indeed, yes, the owner has full control. They have all that independence. They are their own boss, and they have full control of the business. Okay, question 2. So this one asked us then to calculate the total debenture interest for the year. So the total for the year ended 31st of March 2025. So they've got two different debentures. The first one, 6% debentures. It says these were issued on the 1st of December 2022. Well, we're being asked to do this for the year ended March 25. So these were issued then 3 years ago. They've had these debentures all of this last financial year. So £2 million worth of debentures, and it says they have to pay interest at a rate of 6%. So 6% of 2 million is £120,000. Then we come on to the 7% debentures, and these are £1.5 million that they have borrowed, and they've got an interest rate of 7%. So 7% of £1.5 million is £105,000. However, these were only issued on the 1st of January 2025. Remember, we're being asked to do this for the year ended 31st of March 2025. So we've got January, February and March. We've only got 3 months, then they've only had these debentures for 3 months of this year. So they're not going to pay interest for the months when they hadn't got the debentures. So although it's £105,000 a year, we only want 3 months worth of it. So if I divide 105,000 by 12, that will give me 1 month, and then multiply it by 3 to find 3 months. So the interest that relates to the 7% debentures for the year ended March 25 is £26,250. And then I'm going to add that onto the £120,000 from the 6% debentures, and then that brings us to the correct answer, D, £146,250. And the last one, well done if you said C. So this is quite a classic question. So they purchased a new motor vehicle to be used for deliveries. First thing to think is the book of prime entry, and you can see the correct answer is the general journal. The purchases journal is where purchases are recorded, as the name would suggest, but by purchases in this context, we mean things that the business is buying to resell. So in other words, it's inventory, it's stock. And the question specifically says here that this motor vehicle is to be used for deliveries. So they are buying a non-current asset on credit. And therefore, it isn't a purchase in the sense that we use the word in accounting. It is them investing, if you like, purchasing a non-current asset. And so it needs to be recorded in the general journal. and then applying your knowledge perhaps of dead click, or maybe you use the PEARLS acronym. We know then that assets need to be debited to increase them, and a motor vehicle is an asset, which is why we're debiting motor vehicle. But now we have a liability with Get You Moving Limited, who we now owe money to. So hence why we are crediting then the Get You Moving Limited account. Okay, next section then is a quick topic talk. So I'm just going to take a minute or two just to run over a quick bit of theory. Let's see what's coming up. So the classic accountant versus bookkeeper. So this is in section 1, and you need to be aware what the differences are between the role of an accountant and the role of a bookkeeper. So I'm going to start then with a bookkeeper. And key things to think about with a bookkeeper essentially can be anybody. So in some businesses, particularly a small business, the owner might be the bookkeeper. Other businesses might employ a part-time or full-time bookkeeper. And a bookkeeper's main responsibilities, as the name would suggest, is to keep the books. What do we mean by books? Well, we mean the ledgers. So ultimately, in the books of prime entry, the ledger accounts, just maintaining accounting records. So a bookkeeper, for example, one of their most common jobs will be to take source documents and then transfer the details of the source documents into the books of prime entry, and then complete the double entry in the ledgers. They'll also help to do some of the checks on accuracy as they do their work. An accountant is the person then that takes the financial information that the bookkeeper has produced, and one of the key roles of the accountant is to prepare the financial statements for the business owner or the managers. So they use the information that the bookkeeper has put together, and they produce that income statement, statement of financial position, whatever's needed depending on the type of business organisation. The accountant, in addition to that, needs to check that things are true and fair above board. So, for example, they will ensure that the relevant accounting concepts have been prepared in the financial statements. And as I say, they'll make sure that ultimately the information that's being presented shows a true and fair view of the business. It's worth just thinking, though, and remembering that there can be some overlap between the two. The two roles don't have to be completely discrete. So, for example, in some businesses, a bookkeeper might help to prepare the financial statements. They might prepare a trial balance to sort of, bridge that gap in terms of checking the accuracy of the ledgers and helping have that information to hand for the financial statements. Equally, there's no reason why an accountant can't do some of the bookkeeper duties. So they might support, for instance, with some of the ledger accounts. Right then, back to you then. Time for you to do something else. So we're going to complete something called Missing in Action 3, 2, 1. So I'm going to give you a list of source documents, a list of books of prime entry, and a list of ledgers. But there are going to be 3 source documents missing, 2 books of prime entry missing, and 1 ledger missing. And so your task, and I'm going to give you about a minute and a half, is to figure out what is missing in action. Are we ready? So I want to know, what are all these question marks? Here we go. 20 seconds. And time is up. What did we do then? Let's have a look. So 3, 2, 1. See how many you got then. Well done if you managed to get them all. So source documents, remember, are the kind of proof that a transaction took place. So every transaction, there has to be some sort of proof, documentation that it happened. So invoices are essentially almost like a bill for something that we've either purchased or sold. Credit notes are what are produced if something's been returned, either inwards or outwards. A till roll keeps a record of any items going through a till. So, for instance, when customers pay with cash in a shop. Check counterfoils, that's if a business pays with a check. Not used so much nowadays, but if you pay with a check, you have a little counterfoil left where you've made a note of what the check was for, who it was for, how much it was for. And then the three missing ones, the bank statement, an important document confirming all the money moving in and out of our bank account. A cash receipt, so if we purchase something, we might ask for a cash receipt if we purchase it for cash, just something a little bit more formal than just a general receipt you might get in a shop. And then the other missing one was a paying in slip counterfoil. So if you go to the bank and pay some money in, you might have noticed them. They often leave them on the little counter edge, and you end up with a little slip of paper that confirms what you actually paid in. Remember the source documents. The key information from the source documents is transferred into one of the books of prime entry, of which there are 6. So some of them are in pairs. So you've got the sales returns journal and then the purchases returns journal. Also can be called the returns inwards and returns outwards journals. You've got the sales journal and the purchases journal, where there are records kept of credit sales and credit purchases. You've got the general journal, which we've already spoken about, and that's where things that don't sort of fit elsewhere are recorded, such as the purchase of a non-current asset on credit. And then the last one there, the 3-column cash book. The 3-column cash book is an interesting one because it's also used as part of the ledgers themselves, because clearly that's where the cash account and the bank account are. But it also comes under the category of a book of prime entry. And then the ledgers, remember, are just basically books, specific accounting books, which are just full of T accounts, of ledger accounts. So there is a receivables ledger, which all is in there are all of your trade receivable accounts, a payables ledger, which has all the trade payable accounts in, and then a general ledger, which basically has every other account in. So your sales account will be in the general ledger, your machinery account, the general ledger, your rent account, the general ledger, your discount received account, the general ledger, and so on. If it's not a trade receivable or a trade payable, it must be in the general ledger. Talking of ledgers then, so our next activity, we're going to switch to something that I call Ledgerland, and we're going to have a look at a T account. So this first one I'm going to do as a worked example, so let's have a look at it together. At the 1st of February 2024, a business owed £800 for rent. During the year ended 31st of January 25, the business paid £13,500 for rent and £8,200 for rates. The payment for rates covers the 6 months ended 30th of April 2025. Prepare the rent and rates account for the year ended 31st of January 25. Show clearly the amount to be transferred to the income statement. So this is quite a classic question asking you to prepare an expense or an income account, in this case an expense account. And the way I like to think of these is what was going on at the start of the year, what happened during the year, what's going on at the end of the year. So at the start of the year, so if we're doing this for the year ended 31st of January 25, the beginning of the year then would have been the 1st of February 2024. And it tells us in the question, the first thing is at the 1st of February 24, a business owed £800 for rent. So if we owe money for rent, that is a liability. It's called an accrual. So that means we've already got an opening balance of £800 on the credit because, as I say, it's a liability. We already owe that money. It's an accrual. So what was going on at the start? Done. What happened during the year? Well, during the year, it says they paid £13,500 for rent. Rent and rates, this is an expense account. So I'm going to put that on the debit then, as we debit expenses to increase them. It doesn't say how we paid for it, so I'm just going to put bank. Technically, if I put cash, that would have to be accepted. What we don't want to put though is cash book, because cash book isn't an account. It's a book of prime entry. We must have an account. And they also paid £8,200 for rates. So I can't argue with that, so I'll put that in as well then, increasing the expense further. But the little twist in this question, it says the payment for rates covers the 6 months ended the 30th of April 2025. So if it ends on the 30th of April, 6 months, I'm thinking, well, when did that start? So if I go back 6 months, that must have started then on the 1st of November 24. So that rates payment has covered November, December, January, February, March, April, 6 months. But we are only doing the accounts up until the end of January 25. So 3 of those months, February, March and April, are effectively prepaid, a prepayment. They relate to the next year. So out of that £8,200, which remembers for 6 months, half of it, 3 months, is for next year. So half of 8,200 is 4,100, and that represents then a prepayment. And we treat a prepayment, as hopefully you know, as an asset. So they're going to start next year, and you can see I've put it in there, with a balance brought down on the debit of 4,100, a prepayment for rates. And then effectively I can just start working backwards. So there's my total row, and if I'm bringing that 4,100 down on the debit, I must be carrying it down on the credit. And then all I've got to do is make both sides total up to 21,700 because that was the higher amount. And therefore, the missing figure that we want, the amount to be transferred to the income statement that relates to this year for rent and rates, is £16,800. Okay, let's find one for you to do then. So here's a question for you. This time it is about rent received. So just one little tip to get you started. Remember, this is an income account. We're now talking about rent received. So go through those stages. What was going on at the start of the year? What happened during? What's going on at the end of the year? So I'll give you perhaps about 3 minutes then. See if you can prepare this ledger account. Give you about 1 more minute. Last few seconds then. Okay, let's have a look. So, see how you did then? It said at the start there was rent receivable owing of 700, but remember this is an income, so somebody owes us £700. So that's what we call income due. So from our point of view, it's an asset, which is why the balance brought down is on the debit of 700. During the year, we received 14,000 by credit transfer. So that's an income, which is why it's on the credit. They specifically said this time it was received by credit transfer, which would have involved the bank. So the narrative has to be bank. It can't be cash. And then they told us 2,000 of this is for next year. So this is what we call income received in advance. So from our point of view, we need to treat that as a liability. The person who's paid the rent to us, from their point of view, that 2,000 will be a prepayment. But from our point of view, we've kind of had it before we should have had it, so we have to treat it as a liability. It doesn't relate to this year, it relates to next year. So if you like, we can't claim it yet. So that's why that's brought down on the credit. And then working backwards, we can find the figure that needs to be transferred to the income statement is £11,300. Okay, another quick topic talk then. Let's see what we're going to talk about this time. The good old capital expenditure versus revenue expenditure. So there's also something called capital income and revenue income. So let's just remind ourselves of a couple of key things. So capital expenditure is any spending either on purchasing non-current assets or improving non-current assets. So for example, buying a building, premises, a factory, that would be called capital expenditure. If we bought a piece of machinery, a motor vehicle, that's capital expenditure. Equally, as I say, if we improve it in some way, so suppose we extended the factory and had another room built on, that's in improving, if you like, the non-current asset. We can also include anything to do with actually getting the asset in the first place. So suppose we buy a machine and the machine is £5,000, but we also have to pay a £500 delivery cost. I can count that £500 as part of the capital expenditure. Revenue expenditure, on the other hand, is basically the day-to-day spending. It's spending that's recurring. It has to be paid again and again. So things like the wages to your workers, paying the rent, paying the insurance, purchases of inventory, all these things are recurring. They have to be paid again and again. Why does it matter? Well, because capital expenditure is recorded in the SFP, in the Statement of Financial Position, whereas revenue expenditure is recorded in the income statement. And if we muddled the two up, it would ultimately make the profit figures be wrong. Suppose, for instance, we bought a new piece of machinery and we put that as an expense in the income statement. That's going to make the profit for that particular year significantly lower, and that might cause all sorts of problems. The owners of the business might think the business isn't doing very well. They might then make incorrect decisions. So it's all about, as always, keeping things true and fair, making sure that the accounts reflect the position of that business just at then that 1 year or at that particular time. There's also something, as I say, called capital income and revenue income. So capital income is basically income received when you dispose of a non-current asset. So suppose a business decides to sell an old piece of machinery, that would be capital income. It could also be something such as taking out a bank loan. We would treat that as capital income. And again, capital income, just like capital expenditure, affects items in the statement of financial position, such as the cash or the bank figures. Revenue income might be something like rent received that we saw in the last ledger account question that we did. So this is not the, well, it can be the main revenue of a business, the sales revenue, but it's also other little bits of incidental revenue. Right then, so this is something I like to call Calculate Challenge. So let's see how well you were listening to that topic talk. I'm just going to give you 2 minutes for this. A quick question then, using our knowledge of capital and revenue expenditure. Thirty seconds. Okay then, that's about our time. Let's have a look then, see how we got on. And here we have the answers then. So the capital expenditure was the purchase of the van itself and the shelving that we had fitted inside the van that improved the non-current asset. So we can treat that as capital expenditure, 25,800 in total. The revenue expenditure, cleaning, that's a recurring expense then, paying for the van to be cleaned regularly. Fuel, petrol, another recurring expense, as is the insurance. One little sneaky thing that happened here, it asked us to calculate these figures for the first year. and the cleaning contract, it said, was £900 for 18 months. So therefore, I only wanted 12 of those 18 months, and you can see my working there. So we needed to adjust it, which would have just given us £600 for cleaning related to the first year. So that's, again, quite a common type of thing they do in questions in the exam paper. So watch out for these sneaky little things where the time period in the information isn't necessarily the time period that's being asked for in the question. Right, so back to the few multiple choice questions. So you know what to do with these. We're going to have another three. Again, if they're calculate questions, I'm going to let you have about a minute and a half. If they are not calculate questions, I'm going to move it on after about 30 seconds. Last few seconds. And on we go to question 2. And I'm going to move on to the last one then, question 3. Okay. 20 seconds left. Okay, that's about our time. Okay, before we look at the answers, we are a little over half an hour then we've been doing, so we're probably about halfway through this session, this power up session. So I'm going to do about another 30 minutes or so or thereabouts. If you are enjoying the video, please do remember, give us a like, and that will let me know that it's a good thing to be doing, and I can look to do some similar videos for some of the other sections. On to the review then, here we go. So, this first question, the sneaky thing was that the depreciation is time apportioned. So, in other words, we need to consider how many months they've owned it for. They've been nice to us really because it says straight line. So that if it was reducing balance, that would have needed some more calculations. But 12% per annum. So the machine cost £18,500. So 12% of 18,500 is £2,220. If I divide that by 12, that will give me like a monthly rate of depreciation, and then I just need to consider how many months they've owned it for. Well, they bought it on the 1st of May 21, and then they owned it for the rest of 2021, so that will be a total of 8 months. They owned it for all of 2022 and all of 2023, so that's another 24 months. So plus the 8, we're now up to 32 months. And then in 2024, they owned it until the end of November. So that's another 11 months. So add that on and we get to 43 months. So in total, they owned it for 43 months. So take that annual figure of 2,220, divide by 12 months, multiply by 43 months, equals depreciation of £7,955. If I take that away from the cost of 18,500, it means at the time of sale, the net book value was £10,545, and they sold it for just £9,000. So that means they've made a loss then on disposal of 1,545. Question two, hopefully was relatively straightforward because remember in the three-column cash book, the three-column cash book, we have the discount allowed and discount received columns, and therefore that has to be the answer. And question three, so the good old provision for doubtful debts. At the end of the year, the receivables were 7,620. They want to keep their provision at 3.5%. So 3.5% of 7,620 is 26670. But remember, we just need to adjust the balance. So they already had a balance from the start of the year of 28805. So in this case, we actually needed to reduce it slightly down to 26670. So it needed to be reduced by £21.35. A provision is a liability. A provision for doubtful debts is a liability. So it would have had a credit balance brought down, and as we are reducing it, therefore, we need to reduce that balance to offset it. So we would have needed to enter the income statement figure on the debit, and that brings us to the answer A. Okay, next one then, we're going to go back to what I call Ledgerland. And we're going to have a look at some depreciation accounts. Again, I'm going to model one with you, and then you can have a look at one. So let's see what we've got here. At the 1st of April 2024, a business had a balance in its equipment account of £124,080 and a balance in its provision for depreciation on equipment account of £36,300. During the year ended 31st of March 25, the business purchased a new item of equipment at a cost of £11,385. There were no disposals of equipment during the year. The business depreciates equipment at a rate of 33.33% using the straight line method. A full year's depreciation is charged in the year of purchase and none in the year of disposal. And they're asking us to prepare the provision for depreciation on equipment account for the year ended 31st of March 25, showing clearly the amount to be transferred to the income statement. So provisions, I think I mentioned this with provision for doubtful debts. The same idea, a provision for depreciation is a liability account because it's reducing the value of an asset, in this case the equipment. So at the start of the year, the balance in the provision for depreciation account was 36,300. So I'm putting that in on the credit. And then I just need to consider then what's the amount of depreciation for this year. So they've advised us the business wants to do 33.33% straight line. and they depreciate anything they've purchased with a full year's depreciation, no matter when they bought it. So they already had equipment at a cost of 124,080, and then during this year they purchased a further 11,385. So that gives us a total cost of £135,465. And they're depreciating at a rate of 33 and a third, which is basically a third then. So a third of 135,465 is 45,155. And that is the depreciation for this year. You'll see I've put it in. And so that's increasing the total depreciation that they've now done on equipment. If I now balance off the account at the end of the year to £81,455. Remember, straight line depreciation is a calculation based on the cost of the asset, as opposed to reducing balance depreciation, which is based on the net book value of the asset. And remember, net book value is the cost, take away any accumulated depreciation. In other words, any depreciation that is already in the accounts. One for you to do then. So I will give you about 3 minutes. Let's see if you can do this provision for depreciation account. About 1 more minute. Okay, I think that's about our time. Let's have a look. So, opening balance on the credit, because as we've spoken about, it's a liability. The key thing then was the income statement figure, And for this question, it was 20% using the reducing balance method. So therefore, what we needed to do, we needed to find the cost. So similar to the worked example, they depreciate anything they buy with a full year's depreciation in the year of purchase. So the cost then was the 87,150 from the start, plus the new one that they bought, 17,900, gives us a total of 105,050. But then because it's reducing balance, I need the net book value. So I need to take away the existing depreciation of 22,200. So cost 105,050, take away 22,200, gives me a net book value of 82,850. And we want to depreciate it at 20%, which gives us the 16,570. And then balance it off and we can see the new total balance, 38,770. Okay, another topic talk. Right then, trade discount versus cash discount. So the key things to know, trade discount is something that is offered and agreed at the time of a sale or a purchase. So it's often offered to businesses who are like in the trade. So for example, a plumber might go to a wholesaler to buy parts, and because he is a regular customer, possibly buys in bulk or in small regular quantities, they might have agreed to offer him a trade discount. And it's often larger than a cash discount, so it could be 10%, 20%, 30%, 40%. It could be quite a sizable discount. It's almost like a reward for being what's probably a regular customer. Cash discount is often a small percentage, maybe 1%, 2%, 3.5%, and it's something that is offered for settling an amount that's due quickly. In other words, paying an invoice quickly. Most businesses allow about 30 days, about a month, for somebody to settle their invoice. But some businesses might say, if you pay quickly, if you pay, say, within 7 days, you can take a discount of 2%. It's up to the customer whether or not they decide to take that discount. And why would a business offer a discount, cash discount? Well, essentially because it can then help their cash flow. Other things to know, trade discount is, as we've already said, offered at the time of sale and agreed at the time of sale, and therefore it can't be sort of retracted afterwards. It will be deducted on an invoice, and the total shown on the invoice will have had any trade discount removed. Cash discount, on the other hand, is something that the customer then deducts from the total due on the invoice if they are choosing to pay quickly. And if, for instance, they didn't pay quickly, but they tried to get that cash discount, it can be disallowed because the terms hadn't been met. They hadn't paid quickly. Okay, quick calculate challenge then. Let's see how well we've been listening to the differences. Here we go. I'll just give you about 2 minutes for this one. 30 seconds. Okay, then that's about our time. Let's have a look. And there you can see the correct answer, £204.75. So 125 tins at £2.40 each gets us to £300. And he had negotiated a trade discount of 30%. So we can take that 30% off the £300, brings us down to a total due on the invoice. It would have been 210. He was offered a discount, a cash discount of just 2.5% then if he paid quickly. And judging by the dates we're given, he did settle within 7 days. So I can take 2.5% away from the £210, and that brings me then to the correct answer of £204.75. Just something to consider there. You'll notice we have to do this in 2 stages. What we can't do is take 32.5% away from the original £300. It has to be done in 2 stages. Take the trade discount off first to find the total that would have been due on the invoice, and then take the cash discount away from that total if the customer or the buyer, as we are in this case, is paying quickly. Okay, just got about 2 or I think 3 more activities to do then, so probably another 10, 12 minutes together, something like that. So this is something I call What's the Word? Let me show you what it's going to look like and it will make a bit more sense. Right then, so in section 2, as well as types of business organisation, you also need to know about the different sources of finance and the advantages and disadvantages of these. So I've given you here 11 statements about sources of finance. And the pink ones are drawbacks and the green ones are benefits. So each one, I've given you the first letter of a missing word. So I'm going to give you about 3 minutes, see how many of the missing words you can work out. And as an extra challenge, if you've got them all, see if you can make an accounting word out of the first letter of each word. Hope that makes sense. Here we go. 3 minutes. Okay, and let's have a look. So you can see then the correct missing words in bold, in capitals and in bold. I'm not going to do every single one of them because hopefully most of them are fairly straightforward for you to consider. But I'm just going to pick on a couple of them and just explain a couple of things. So the fourth one, bank overdrafts are flexible, is probably the main advantage of a bank overdraft. So if you arranged an overdraft of say £1,000, you don't, unlike a bank loan where you would then be lent that £1,000 and you're paying interest on all of that £1,000 straight away. With a bank overdraft, you can just dip in and out of it as and when you need it. So it might be that you only need to borrow £100 on day one, so you only pay interest on £100. And then on day two, you get some money from a customer and it takes you back out the overdraft, so you don't pay any interest in day two. But on day three, you've got a big bill to pay and it pushes you into a £300 overdraft, but you just pay 300 interest on the £300 on day three. Day four, a customer gives you £200, so now you're back down to a £100 overdraft. So now you're just paying interest on the 100 and so on. So it gives you a bit more flexibility in terms of your borrowing, unlike something like a loan. But it's worth remembering that the interest rate on a overdraft is normally considerably higher than on a bank loan. What was the other one I wanted to consider? Oh yeah, the security one. So security or collateral. So certainly mortgages are secured, debentures quite often are secured, even a bank loan can be. Not always, but by security, what it means is you might be expected to give up one of your assets, a non-current asset, as security. So you can still continue to use the non-current asset, but the bank or whoever will have a hold on it. So if, for instance, you don't pay the loan back or you stop paying the mortgage back, the bank will have the right to take that asset and sell it in order to try and recover the money that they lent you. And the only other one I was going to mention was the next one along. Debenture interest and repayments become easier over time due to inflation. And what I mean by this is, debentures are often very long-term finance, maybe 15, 20, 25 years. So suppose you borrowed £500,000 today and you were going to repay that in 20 years' time. Remember, with the way debentures work, you will pay interest at an agreed rate each year, so say 5%. But that then you maintain that every year for 20 years. And then in 20 years' time, you will repay the £500,000 that you borrowed. Well, in 20 years' time, because of inflation, £500,000 won't seem like such an amount of money as it does today. So, and equally, the annual interest payment won't seem quite so onerous each year. So, as payments are made, it starts to become a little bit easier over time. And well done if you got the key term. So if you take the first letter of each of those words and rejumble them round, you will find the magic word then, counterfoil, which we've already talked about in this power up. Okay, next thing then, two things left to do. Back to Ledgerland. And I'm going to throw you straight in here then with a classic question, preparing an inventory account. So let's see how much you know or can remember about these. I'll just give you just 2 minutes. See if you can prepare this inventory account, please. Last few seconds. No. Okay then, let's see. Here is the answer then. So the inventory account is a little bit of at first glance, a bit of an unusual account, but there is logic behind it. So inventory is an asset, which is why the balance brought down at the start of of January is on the debit. They own 6230. But the logic is, if that's what they had at the start of the month, they won't have that at the end of the month. So because the business has presumably been trading for that month. And so you'll see that figure at the end of the month gets transferred to the income statement, to the trading section. And hopefully your knowledge of the trading section of the income statement, you know that in the cost of sales section, we start with the opening inventory. And that's why that 6230 is being double entered to there. And then at the end of the month, this business has inventory that's 10% lower than it had at the start. So I've taken 10% off 6,230, which has brought me to 5,607. And so effectively, probably the easiest way to do it, I always think, is just to work backwards. So that means they're going to start February with an asset of 5,607, which you'll see I brought down on the 1st of February on the debit. And if I'm bringing that down on the debit, I must be carrying it down on the credit. And then the other missing figure then is the income statement again. And again, as you'll know, your cost of sales section in an income statement, at the end of the cost of sales section, we need to subtract the closing inventory, which in this case is the 5607. And that's why we have two income statement figures in here. One is the opening inventory, one is the closing inventory, because those two figures are both needed in the cost of sales section of the income statement. You might be thinking, well, why is one of them on the credit and one on the debit? Well, that's because in the income statement, ultimately, the opening inventory is a positive figure. It increases the cost of sales, whereas the closing inventory reduces the cost of sales. Right, we're coming around to the very last activity then. Again, thank you for joining me with this Power Up session. I hope you have been finding it useful. Please do subscribe, like, share, and comment. And so to finish off then, we will finish like we started with 3 final multiple choice questions. So stand by, I'm going to get straight into them. Here we go. 5 seconds. And on to question 2. Last few seconds. And on to our last question in this Power Up session in 3, 2, 1. Here we are then, question 1. So if you were doing an income statement, which of these would not be added under the gross profit as additional income? And it's the top one, because an increase in provision for doubtful debts is bad news, because now there's even more of your trade receivables that you worry that you might not get, and so that would be treated as an expense. A profit on disposal, yep, income. Irrecoverable debt recovered, a bit of extra income. Discount received is also treated as income. Question 2. So this is in section 1, the differences between financial accounting and management accounting. And so this one here then, management accounting is mainly for the use of internal stakeholders, which is why the answer is A, because that isn't true. Sometimes some of it, such as a forecast income statement, might be shared externally, but the majority of what's done in management accounting is used by internal stakeholders, mainly by managers and decision makers. It does generally focus on the future, whereas financial accounting generally focuses on the past and what has happened. Capital investment appraisal is an example of management accounting, along with things like budgeting and standard costing, and types of costing methods like marginal costing. Financial accounting, remember, is more about actually preparing the accounts, the ledger accounts, income statements, statements of financial position, and so on. And information doesn't need to be presented in a regulated format. Yeah, that is true about management accounting. Although most businesses will follow similar formats, they can tweak things to suit their own style because it's just for internal use. Whereas in financial accounting, things like income statements, statements of financial position, statements of cash flow, they do need to be presented in a certain regulated format. And the final question then, here we go. Jazz, which of these should not be in his current liabilities section in his SFP at the 31st of March 25? And the answer then, insurance prepaid, because that to him is a current asset. Just a quick thing there on part A, overdraft, yeah, liability. The bank loan, always just double check with the bank loan when it's due for repayment. Remember, current liabilities are things that will need to be paid within the next 12 months. Well, if he's doing his SFP at the 31st of March 25, this bank loan will fall due for repayment within the next 12 months in January 26. So a bank loan often is a non-current liability, but in its final year, when it's due for repayment, it will become a current liability. Same as a debenture or anything else, anything that's got to be paid in the last 12 months. Rent received in advance, we've already spoken about this earlier on in the session. That is what we call income received in advance, and that is a liability. And there we have it. Hope you've enjoyed this power up session. Please do share the videos, like, comment, subscribe, and look forward to speaking with you in another video.